My name's Ronan from Group 31. Today I'll be presenting my contributions to the Applied Portfolio Management Group Report. Backtesting is an essential tool used by traders and investors where a strategy is tested in a historical environment using the benefit of hindsight. The following findings result from backtesting a quantitative strategy seeking to capture industry momentum factor through a trend following strategy. Exercise 9.2 focuses on constructing the winner portfolio of our long-short strategy. Exercise 9.5 focuses on calculating the cumulative return and plotting these returns on a graph over time. And finally, exercise 9.7 aims to implement a robustness check on the baseline long-short strategy we've constructed by seeking an optimal end, top or bottom industries. The results determined from exercise 9.2 are as follows. The annualized average excess return of the winner portfolio is 11.44%. The annualized volatility of the returns is 6%, and the annualized Sharpe ratio at 0.58. As we can see in the table, the winner portfolio outperforms the market benchmark and loser portfolios in terms of risk and returns. Previous literature on the long-short industry momentum strategy highlights how the profitability of such strategy is attributed to the long positions in winner industries. This is due to the underreaction theory founded by Greenblatt and Hahn, where winners exhibit greater reversal momentum after bear markets. Conversely, in the graph sourced from FactSet below, we can see that the excess returns of the loser portfolio exceed that of the winner portfolio. Interestingly, the portfolio of winners and losers in the graph below consisted of individual stocks rather than industries. The look-back period for their strategy was also greater than ours at 1, 2, 3, and 5 years rather than our 12 months. As we can see in the graph above, the ranks of each portfolio based on the cumulative performance are winner, market, long-short, and finally losers. The green and blue highlights indicate when the long-short strategy portfolio has outperformed the market and all other portfolios respectively. We can also infer from the graph that the long-short portfolio performed well during recovery periods such as the Great Depression and during the oil crises. Contrastingly, the graph below shows the cumulative returns plotted, but with contradicting results. As mentioned previously, these portfolios were constructed using individual stocks rather than industries. The graph depicts the large source of cumulative returns is the loser portfolio, which on average outperforms all other portfolios, including the winners and the market benchmark. Moskowitz and Greenblatt mentioned that industry momentum yields the highest returns in shorter horizons, but the momentum factor can translate into reversal factor during longer horizons or look-back periods. In the final exercise, we used Seekit to try optimize the Sharpe ratio of our baseline long-short strategy, and it was found that we could amplify the annualized average excess returns by 0.05% and minimize the volatility of the returns by 0.31%, all whilst reducing our beta to the market and increasing the alpha of the strategy. On the left, I constructed a graph plotting the cumulative returns of the baseline strategy versus the optimal strategy over time. As we can see, during the look-back period, the optimal strategy cumulative returns only consistently outperformed the baseline strategy after 1997, as indicated by the green highlights. We can infer from the graph that the outperformance of the baseline strategy pre-1997 may be tied to the 2 extra industries that were disregarded in the rebalancing of our optimal strategy. However, cumulative performance is not the best indicator of the overall performance, as these 2 industries may have caused the increased volatility of the portfolio. To conclude, some key considerations from backtesting the trend-following strategies are: the construction of the portfolio will vary the results. Changing the construction of our trading signals, such as implementing a greater look-back period, the selection of what equities to trade, as well as narrowing down the scope of how many equities to trade, may have a significant impact on what factor we capture, as well as the performance of our strategy. The portfolios constructed in the FactSet article aim to capture mean reversion rather than the trend following in our strategy. It is also evident that the frequency of rebalancing is highly important, where the FactSet portfolio is considered rebalancing yearly, whereas ours monthly. After implementing the robustness check, we can infer that the momentum factor exists outside of the baseline portfolio, and that there are specific ways we can improve on such strategy to reduce risk and amplifying returns, whilst deriving significant alpha. Thank you for listening.